Welcome to China Truths. In this episode, we will bring you the following story. Chinese yuan crash in 2025? A surge in capital flight expected. Now, let's dive into the details. It's all covered in today's China Truths. Chinese yuan crash in 2025? A surge in capital flight expected. As the year draws to a close, the recently concluded Central Economic Work Conference of the CCP unveiled policies for active fiscal measures and moderately relaxed monetary policies. However, China's economy remains in a precarious state. The latest data reveals that in November, capital outflows, also known as capital flight, from China reached a record-breaking $45.7 billion. Zhai Xianying, the former president of the investment banking division at China Construction Bank, predicts that the Chinese yuan will experience a substantial devaluation in 2025, signaling a peak in capital flight. Li Jun, an independent TV producer, said that according to official CCP data, November 2024 saw a historic outflow of capital from China's capital markets, totaling $45.7 billion. Data from the State Administration of Foreign Exchange, SAFE, shows that in November, cross-border investment income amounted to $188.9 billion, while outflows totaled $234.6 billion, resulting in a deficit of $45.7 billion, the largest monthly deficit in history. Li Jun noted that for the past 2 to 3 decades, this figure has traditionally been positive, reflecting a surplus. Even in early 2022, when China's economy was still struggling due to the pandemic, there was a surplus of $100 billion, suggesting that foreign capital continued to invest in China. However, by the end of 2022, this surplus sharply plummeted to around $20 billion, and in the second quarter of 2023, it became a negative value of more than $10 billion for the first time in 2 to 3 decades. Despite a brief rebound, October 2024 saw a deficit of $25.8 billion, and November further expanded this to $45.7 billion. This marks a significant turning point in the history of China's capital flows situation. Zhai Xianying, former head of China Construction Bank's investment banking division, suggested that capital flight is still in its early stages, with the real wave of outflows expected in 2025. According to Zhai, the recent outflows are merely the beginning of a larger trend, as more cautious investors begin to move capital out of China in anticipation of greater instability. He forecasts a peak of capital flight in 2025 and notes that by 2026, the external environment may not be conducive to such movements. He explained that during the months following October, there should be rapid foreign exchange growth due to the forced settlements of foreign exchange for export enterprises. If this were the case, the Chinese yuan should be relatively stable, but the current trend is already alarming. Zhai warned that once the forced settlement period ends, the outflows will likely intensify. He also predicted that the Chinese yuan will undergo a massive devaluation in the near future, potentially far beyond what is currently imaginable. He explained that with a population of about 1 billion, out of the total 1.4 billion, if just 100 million people each took advantage of the government's annual foreign exchange quota of $10,000, that would result in a total of $1 trillion being moved out of the country. Zhai emphasized that the real capital flight has yet to fully materialize because Chinese citizens are generally slow to react and often act only after rumors and information spread widely. Zhai further explained that the capital flight in recent months is only partially visible. He revealed that in the fourth quarter of this year, much larger amounts of capital have been moved out of China via decentralized cryptocurrency exchanges such as Binance, where Chinese citizens have been converting their yuan into USDT, a type of stablecoin. The Chinese government does not provide citizens with easy channels to exchange yuan for dollars, which has pushed people to seek alternative methods. Senior media figure Guo Jun commented on a significant symbolic event that occurred the previous week. The 30-year Chinese government bond yield dropped below that of Japan's 30-year bonds for the first time in history, a clear indicator of deteriorating confidence in China's economic future. In comparison, the US 30-year bond yield is 4.755%, while European countries such as Germany, 2.534%, and France, 3.64%, offer higher yields than China and Japan. Gua emphasized that this drop in the Chinese bond yield shows that China's 30-year bonds now offer the lowest returns among all major global economies, while the risk associated with these bonds is exceptionally high. Foreign capital invested in China, estimated at around $2.5 trillion, is increasingly likely to leave, as investing in U.S. bonds offers almost double the return with significantly lower risk. Gua stated that the Chinese yuan is bound to continue its depreciation. Exchange rates are essentially determined by supply and demand, and the government's control over these factors can only maintain the currency's value within a limited range. With China still claiming large foreign exchange reserves, the government can control the currency to some extent, but the pressure on the Chinese yuan will intensify if China's economic downturn continues and foreign capital exits in greater volumes. He also pointed out the potential for the incoming U.S. President, Donald Trump, to escalate the trade war with China, possibly imposing more tariffs, which could lead China to devalue the yuan further as a way to offset the impact of the tariffs. Xi Xianing also discussed a common misconception about China's foreign exchange reserves. Many people believe that the Chinese government holds vast reserves, but Xi clarified that this is a misleading impression. The reserves often cited by the government do not reflect the full picture, as a significant portion of the reserves consists of liabilities. As of 2023, China's foreign exchange reserves totaled $3.2 trillion, but the country's external liabilities amounted to approximately $2.45 trillion. This leaves a net value of only around $700 billion. Furthermore, the reserves are not entirely in US dollars. They include other currencies such as the Russian ruble, Vietnamese dong, Malaysian ringgit, Thai baht, and offshore yuan, which are counted as part of China's foreign exchange reserves. In reality, China's reserves in US dollars are significantly lower than the official figure suggests. Xi noted that much of the foreign exchange reserves come from businesses and individuals engaging in foreign trade or exchanging currencies. These reserves are not the Chinese government's money but represent the transactions of international businesses operating in China. Xi also stressed that China's economy no longer has a core industry driving growth. As seen in the most recent Central Economic Work Conference, China's economy lacks vital sectors that generate significant revenues. Instead, China is increasingly relying on borrowing to stay afloat. Xi noted that in past years, specific industries were highlighted as key drivers of economic growth, but this year, only vague mentions of the Hainan Free Trade Port and artificial intelligence, AI, were made. Xi highlighted that China's fiscal situation is precarious, with government revenue expected to be about 20 trillion yuan or $2.74 trillion, while expenditures will reach 40 trillion yuan or $5.48 trillion. A significant portion of the spending is on debt issuance, including local government bonds and national debts. This reliance on borrowing to cover expenditures indicates that China is essentially borrowing money to survive. In summary, Xi warned that China's economy no longer has the essential industries or revenue sources it once relied on. With industries like real estate and foreign trade rapidly declining, he questioned the future of China's currency, which has become increasingly decoupled from the country's economic reality. As China faces mounting economic challenges and increasing capital flight, the forecast for 2025 is bleak. Experts predict a significant devaluation of the Chinese yuan, further exacerbated by the mass exit of foreign capital. With China's foreign exchange reserves increasingly insufficient and its core industries faltering, the country may soon face an economic crisis of unprecedented scale.